Okay, Assalamu alaikum. So, in this video now, I'm discussing capital budgeting, and specifically the technique that I'm going to discuss is net present value, right? So, but before I discuss net present value, let me just briefly tell you what capital budgeting is. Okay, when we talk about capital budgeting, we are saying that, let's say we have an asset and we have to invest, we have to make an investment because we need a long-term asset with which we want to do some work in the long run. Let's say I have a choice between, I'm a constructor and I have a choice between buying 2 cranes, alright? So I need cranes for my business. This is a long-term investment. So as I discussed in economics, investment means the money that you put in long-term durable assets. Okay? Now your crane is a long-term durable asset. Why? Because it's going to last 20, 30, 40 years and it's going to give you revenue over a long period of time. But we have to intelligently and scientifically appraise, kind of evaluate which crane I should make the investment in. I have one crane from IKEA and I have another crane from Caterpillar, alright, and I will buy one of those. I need to buy one crane. Which crane will I buy? So the process of determining which investment I should make, which asset I should invest in, the process of appraising is called capital budgeting or investment appraisal. Alright, and there are 4 methods of doing investment appraisal. Appraising an asset, determining which asset I'm going to make the investment in. So there are 4 methods. The first is payback period, number 1. The second is accounting rate of return or average rate of return. The third is net present value, and the fourth is internal rate of return. So in this video I am discussing how to calculate the net present value of an asset, and if you are given 2 assets, which one you should choose on the basis of net present value and how. Okay, so let's do this with the help of a numerical question. Okay, so we have the opportunity to make an investment, and we have to buy a crane, and there are 2 cranes. One is the IKEA crane and the other is the Caterpillar crane. Okay, I need one crane only. Which one should I invest in? Alright, so what happens in finance is that no matter what the asset, you convert the asset into the cash that the asset will generate for you. Because remember, for a business, the asset is not the comfort or the beauty or the aesthetics of an asset. The asset is the cash that the asset will generate. So how good is the asset? The asset is only as good as the cash it generates over its lifetime for the business. Alright, so crane number 1, well, I'll call it C1, and this I'll call C2, right? So what happens now? Create a timeline for the asset. Okay, now this is pure estimation, and this is done by the finance manager, keeping his knowledge, his experience and his investigation into the how good the asset is. So this crane that you buy, okay, how much are you going to invest in this? The investment that happens is in year 0. The year in which you invest is also always called year 0. The first year is the year from which positive cash flows start coming. I'll just explain what that means. Okay, so this is the life of the asset. Both assets have a life of 5 years. Okay, this is just a very hypothetical example.
that an asset has a life of 5 years. In year 0, you will make the investment. You will buy the asset, okay? So there will be a cash outflow. Outflow is shown by a bracket, okay? Year 0, you make an investment. Now you can make an investment of 500,000 here in this crane, or you can make an investment of 600,000. The cost of this crane is 600,000. The cost of this is 500,000. Okay. Now in the first year you have made the investment. In year 0 you have made the investment. In the first year this asset will give you, let's say this asset will give you $70,000. Okay. Now this is not bracket, this is going to be 70,000 because this is positive, it's coming in. This bracket showed the money was going out. So this is cash inflow. So cash inflow, and this is cash outflow. And we have to compare the cash inflows with the cash outflows. So you get 70,000 here. Let's say you get 100,000 here. Let's say you get 400,000 here. Let's say you get 200,000 here, and you get 200,000 here, right? And likewise you get about 80 here, you get 150 here, you get 300,000 here, you get 300,000 here, and you get 150,000 here. Sorry, 450,000 here. Okay. So now this is the cash that this crane will generate. It's going to give you. So this will be the cash inflow, and this is the cash that this is going to give during the life, during its life. Now these cash inflows will be compared with the cash outflow. These cash inflows will be compared with this cash outflow, and then whichever crane gives the higher net cash flow, which means, what does net cash flow means? Cash inflow minus cash outflow. Wherever this value is higher, that asset will be chosen, but with one caveat. The caveat is that, look, 70,000, let's look at year 1. 70,000 you are earning in year 1. Okay. Now according to the basic rule of finance is, if you have $100 in your pocket today and you have $100 in your pocket 2 years from now, which $100 are more valuable? The money that you have today or the money that you have tomorrow? The money that you have today is more valuable. Why? Because 1 year from now, 2 years from now, there's going to be inflation, and there are going to be other factors which is going to reduce the value of money. Primarily because of inflation, money loses value over time. So this concept is called time value of money. Okay, so you have to take into account time value of money. This money is coming, this 100,000 is coming in year 2, after 2 years. So this 100,000 after 2 years and 100,000 today are not equal. So what do? You are going to find out the value of this 70,000 which you will receive after 1 year. You are going to find the value of this 70,000 today. How do you do that? You find out what the prevailing interest rate in the economy is. Alright, that interest rate or that rate is called the discount rate, and that will always be given to you. So let's say the discount rate in the economy is 10%. Okay, 10% is the discount rate. The 10% will apply here, the 10% will apply here. So now what will you do? You will go to the discount table. This will be given to you. And in the discount table, you have these interest rates here, 1%, 2%, 3%, 4%, 5%. And yeah, this is the relevant interest rate. It's 10%. Okay. So 10% interest in the first year. So this is the first year. Correspond with 10. What is the factor that you get? It is 0.09, I believe. Yes, it is 0.09. So what will you do? Simply 70,000 multiplied by 0. It's 0.909. I can't see clearly, yeah, it's 0.909. So it's 0.70,000 into 0.909. Okay, so the value of 70,000 today is 63,630. So 63,630 today is equal to 70,000 after 1 year, and this is going to give us 70,000 after 1 year. So the value today is 63. So we will take this amount, not 70,000. Likewise, now it's going to give you 100,000 in the second year. So let's look at this very carefully. 10% and the second year, period number 2, second year is 0.826, right? So 100,000 multiplied by 0.826 is equal to 82,600. Okay, likewise 400,000 multiplied by 0.751, which is here 0.751, if I see this clearly. So this is 300,000, 400, 200,000 likewise. Now we will maintain the same 10%, but we will look at the rate applicable in the factor applicable in period 4 or year 4, which is 0.683. Multiply this by 200,000. This is 136,600, and then 200,000 in year 4 has a value of 136,600 today, and 200,000 in year 5 has a value of 0.621. You will multiply 0.621 with the factor with the amount of 200,000, and now the present value will be 124,200, right? So these are the discounted cash flows. These are the real cash flows that will happen at nominal value, but once you reduce the value to today, we discount it back to today. What's the value of this today? We get all the discounted values today. Now add up all these discounted positive cash flows. Okay, so it's 63,630 plus 82,600 plus 300, 400 plus 136,600 plus 124,200. Okay, so you get total positive cash flows after discount 707430 minus the initial investment of 500,000 from this, and you get 034,702. So you have, after discounting the positive cash flows and minusing the initial investment, you get a positive answer of 207,430, right? So the rule in net present value is that if after minusing the outflow from the inflow you get a positive answer, then this project can be accepted, provided this positive answer is more than the answer that you receive after doing all the calculations from the second asset. So now your job is to find out the net present value of this crane, okay, the other crane, compare it with this and see which value is higher, and then decide which asset you will choose. Okay, so go through this very carefully, do this calculation again, If you have any questions, leave your questions in the comment. I'm going to explain it to you again. But this is very simple. It's very self-explanatory. You can go back, rewind this video, watch it again. The rule is very simple. You develop the timeline, see the positive cash flows, but discount them back. The value of this, for example, this 400,000 after 3 years, the value has to be discounted back today. So 400,000 3 years from now is equal to 300,400 today, given that the rate is 10%. Okay. So I hope you've understood this. This discount table will always be given to you in the exam, so you don't have to worry about this. All right. Please do this question and find out which of these two cranes is a better investment. Okay. Thank you very much indeed.